welcome to approximately 150 people who have registered. Good evening, everyone. A warm welcome to the Masterclass Selecting Stocks Like a Pro, presented by Rowan Nijboer. We are incredibly happy that you are here, Rowan. We at Happy Investors are both proud and excited about this first collaboration, where we not only give our existing members, but also new members the opportunity to further expand their credits. This is an important milestone for us, and we believe that this masterclass will offer valuable insights for everyone that will be directly applicable. This masterclass fits perfectly within our mission and strategy to create an accessible path to financial freedom for everyone. It is our belief that knowledge is the key to making well-informed financial decisions, namely, and we hope that this session is an important next step on your personal journey to financial independence. That's somewhat the idea of why we are organizing this. Before we begin, a few housekeeping announcements. It won't be the first time people are attending a webinar, but still, these webinars will last approximately 45 minutes. That includes time to answer some questions at the end. The entire webinar will be recorded and will later be made available on our Happy Investors website, so you can comfortably watch it back. During Rowan's presentation, you can ask your questions via the chat, as is already happening a bit now. At the end of the session, we will try to address as many questions as possible. It probably won't be possible to cover everything, but we'll see. And then Rowan will also take a look to see, hey, did I mention some things or did I forget something? And still, practically to prevent background noise, we kindly ask you to mute your microphone because it is also being recorded and it would be very annoying if your son or daughter or any pet is heard in the background. And we hope you will learn a lot and enjoy the masterclass. And at the end, we will come back for a brief closing. So have fun and see you shortly. Rowan.
Thank you. I will take my microphone off mute, but I am really looking forward to it. Thank you, Frans and Happy Investors, for this opportunity to be here. Really great. It's always nice to talk about investing. It's my great passion. I started when I was 15. I didn't understand a thing about it yet, but my father put me in front of Teletext, page 520. There you could see the 25 largest publicly traded companies, ING, Shell, Hine, those kinds of things, and that you could earn money by basically sitting on your butt. Yes, I found that fascinating. Of course, I still didn't understand a thing because a few years later, with my own money, since you can't have a broker account before you're 18, I started investing. And I thought, now it's going to happen, earning money with the paper routes and things like that. That went completely wrong, of course. The financial crisis, I bought shares, for example, SNS Real, and that stock price had already dropped significantly. I was only looking at that chart. I thought, this is a great opportunity. Moreover, the management told me, well, we are a Dutch bank. The financial crisis is in America. Don't worry, dear investor. The dividend, and we pay a nice dividend. Well, I thought, this is a jackpot. Well, yes, how foolish could I be to just go along with it and not do my own research? Somehow it really triggered my interest, having studied for it. And yes, now, yeah, what is it by now? I'm getting old, 22 years later. I am a professional investor and have turned my hobby into my profession in that regard. And I enjoy taking others along with me in it because it's just a lot of fun, but it can also be very dangerous. Because I was just talking about SNS Real. My father had all his invested assets in SNS Real, and he held on to them for a long time until the bankruptcy. So he lost all his money. It is now a nationalized bank. But that really triggered my interest. How does that work? How can my money disappear so quickly? And I think it's really easy to lose a lot of money on the stock market if you do very stupid things. But if you just do some sensible things, then everything will be fine. Come, and I hope to show you some of those sensible things today. One sensible thing is, for example, index investing, ETF investing. Well, there will be many who might already be doing that. That always seems like a very smart machine to me. The science. As a student, I was lucky to be able to research which investment methods work. Well, many methods work and don't. But science actually says that 80% of people who select individual stocks, something I do, being one of those stubborn people, that's what we actually are, perform worse than an index fund in the long term. Well, that's a statistic that's heavily against you. But if you're going to do it anyway, yes, I am. Try to increase your chances of being in that 20%. And what you essentially take with you in your own life after today and how you're going to apply that. That's, of course, up to you. In that regard, I don't give advice. Then it's just education. I'm just going to make a thunderous, fun attack. Now I'm going to share my screen. You should be able to see it. If not, let me know. But this is, of course, Warren Buffett. Because, yes, index investing. I already mentioned it. 8% return on the long term over the past 200 years with many ups and downs. But Warren Buffett had 20% per year. And that has resulted in him investing for over 70 years or longer, that he has invested approximately $200 billion. But he had three brilliant things. One is quite a lot of money at the start. And he had a good return. And he has a very long horizon. These three things lead to extreme wealth. If you have two of those three, that already makes a difference, because we don't all need 200 billion. Hey, we have no use for that. And the man himself doesn't care about money. By the way, he is a poor fellow compared to a Musk who has about double. But anyway, both will be comfortable in the winter. But two of those things can already lead to life-changing events. And if you have a difference in that return, not just 8%, but a bit more. I have had 14.6% over the past 14 years on average per year, including some very bad years. But in the long term, that leads to very nice things. But it's not free. You will have to do your homework. You can't expect that after today. You can invest like Buffett. You also can't fly a plane in one day. So it takes time. The masterclass is called Selecting Stocks Like a Pro. After today, you won't be a pro. That might be a bit naive, but it's a good foundation, and I will give the key points so you can build a nice portfolio with interesting stocks. And what is very good is to realize that there are 40,000 publicly traded companies. So where do you start? Every company is different, but every company is essentially the same as well. Every company has four internal aspects. And one of them is the revenue model. And those four aspects that I am about to mention, and actually the guideline for every successful investment, if those four are well in order, the chances, it's not a certainty, but the chance of a successful investment is much greater. For me, 3 out of 10 stocks also don't perform as I had expected. That's just how investing is. That's why we diversify, just like my dad taught me. The first is the business model. Yes, farming was mentioned at the beginning in that name, and it triggered me a bit. I don't invest much in biotechnology companies because I don't have a PhD in pharma or medicine. I don't really have a competitive advantage there. Other investors are very good at that. For me, it's then I don't understand it well enough, so it's outside my circle of competence. And then I naturally stay away from it a bit. And then many of those 40,000 companies are already eliminated. And yes, how do you test if something is within a circle of competence? Well, one way is through common sense. That's actually always the case with investing, but also by asking how, where, and with what does the company actually make its money? And sometimes there are very specific things in that. For example, people invest in Ahold because they think Albert Heijn and Bol.com. Those are such fantastic companies, while 2/3 of Ahold's revenue comes from America. And there are supermarkets that Albert Heijn is very dominant here in the Netherlands, but that's just a small part of Ahold. In America, they are not the dominant player. There you have a Walmart, you have a Costco, you have an Amazon entering that market. That is just much tougher. So understanding such a revenue model within the circle of competence is extremely important. And that is often, overlooked. The management, extremely important, because when you buy a share, it means you are essentially giving your money into the hands of the management, the CEO, the CFO. Often they are in it for themselves. We will delve deeper into these points later. Competitive advantage. How can a company distinguish itself from others? Well, the great thing was with the companies you mentioned, like an ASML, an Nvidia, Amazon, Adobe, Alphabet, Triage Group, parent company of Action, Novo Nordisk, Wolters Kluwer. All those companies can. I haven't mentioned a few as well, but those companies can distinguish themselves well from competitors. And that makes them a good investment for most of them in the long term. We'll get into that shortly. If those first three are good, then beautiful finances essentially emerge from that. That is the result, the profitability, the revenue growth, and what you want to look at, the company's debt position, because that is also important. A company can make very beautiful products, but if no profit is made from them, you have nothing as a shareholder, because that profit eventually comes to you in the form of dividends or a price increase. That is the internal layer. Then you have the outer layer, because it's good to have insight into what the company is trying to disrupt. What was always a rule for me, to not have more than 2 large tech companies. Is it regulation? Now with Trump, that risk is a bit more relaxed, somewhat faded into the background. But those large tech companies and regulations and fines and possibly breaking them up, those kinds of things are a threat to the big tech companies, because they are, of course, very powerful in those other factors. Competitors. Competitors always try to take a share. Powerful suppliers. Powerful customers. Look, a company like Air France KLM, a beautiful company. But if you look at the stock market over the past 20 years, even before Corona, it's dramatic, because they have quite powerful suppliers, Boeing and Airbus. Those are 2. So they have everything to say. And their customers, they shop on Skyscanner or cheaptickets.nl for the cheapest price. That is a particularly unfavorable position in that regard. And when you talk about competitors, there is also an extreme amount of competition. And there are all sorts of regulations, so that, for example, they cannot expand further at Schiphol. Well, if you've studied the company, it can be perfect. If the valuation is too high, you won't make a good investment. A Tesla, I sometimes say it's a fantastic car. Of course, now it's all become a bit more politically sensitive and such, but a beautiful car. But if you pay $1 million for that car, you're definitely making a bad deal. And it always surprises me that people don't look at the price of what they are paying. I mean, if you're going to buy a house, you also look at what you're paying for what you get. If you're going to buy a secondhand car, you also look at various factors like the mileage and the price. Yes. It depends on that. And on the stock market, people sometimes buy a stock just based on the price. The price has dropped by 30%. Yes, that doesn't necessarily mean anything. Maybe the price should drop by 50%, or maybe the company is going bankrupt. Yes, then you fall behind in valuing. And it really helps to guide yourself through volatile market conditions, because you calculate this is what the company is worth. The stock price is well below that. Well, then you have a margin of safety, and then the chance of success is much greater. Well, a good question you should always ask: if you buy a share, it means someone else is selling it to you. Why would you know better than the other person? A well-known saying is, if you don't know who the fool at the poker table is after half an hour, if you still don't know, it means you are the fool. You also have to ask yourself if you can do it in 5 minutes. You can then buy a stock and that it will go well while a professional is selling it to you. And psychology is the number one enemy. Okay. If I may give you 2 things in that regard on what to focus when selecting stocks, because it is very important. I have full time to invest in a week. The chances are high that you don't have that you might have a few hours a week. It's really fun to do, so it takes up time. Maybe you can even do a bit during work hours, things like that. But many people don't have many hours in the week to invest. So what you want to do is build a kind of low maintenance portfolio where you can actually ride the success of companies. All those names you just gave me. Yes, there is no one who has stayed with Amazon since its IPO in the 90s. The only one who did that is Jeff Bezos. And that's why he became so rich. He could have ridden along, but it has been an incredibly difficult ride. What an emotional journey. Because the Amazon stock, I believe, has dropped something like 3 times, 50% or more. And even once by 90% in the year 2000. Almost no one can handle that volatility in the long term. But if you have found a good company, you've done your research, then you can just ride along with it. So for many people, a kind of low maintenance investment strategy is really recommended because it just fits with your life. 10, 20 companies. Do thorough research at the beginning and then just ride along. I will also get to when there is a reason to sell. But if you fill your portfolio in that way, and companies that meet 2 criteria, the 2 most important ones, fashion and management. And moat is the English word for a defensive ditch. You only want to invest in castles. Hold on a second. You only want to invest in castles that are surrounded by moat, preferably with deep sharks and crocodiles in it, that protect the castle from intruders. Intruders in this case are competitors, because capitalism is ruthless. If you, as an entrepreneur, have a good idea, for example, you run a sandwich shop, you make the best sandwiches in Almelo, and someone sees how you do it, and they can simply copy it. They can just sit right next to you, so to speak, and try the same thing, and maybe at a slightly lower prices, and thereby take business away from you. Your profit margins disappear like snow in the sun. In the capitalist system, purely through competition, that is tremendously beneficial for consumers. Because of that, we get lower and lower prices. Look at the airline industry. I just mentioned Air France KLM. The only winner in the past 50 years in the airline industry is the consumer, because they have experienced continuously falling prices. And the airline industry as a whole has not been profitable over all those years. Some are, some aren't, but overall not. It's due to that intense competition. And anyone can start an airline. You can just rent a plane and start flying. Well, it's not that easy, but you get the idea. If you're a castle, then it's not so easy to compete in the current market. What are examples of castles? I thought my shortness of breath was over, but I have a young daughter and she is often sick and at daycare. And that first winter is really exhausting. But well, the nice weather is coming. So these are the after effects. But sorry, if you're still a bit bothered by it, you can distinguish yourself as a company with a strong brand. The strongest brand in the world is probably Ferrari. You have Hermes, you have Louis Vuitton. Almost all such companies are publicly traded. They are often good investments. And how do you know if something is a strong brand? I always find that very interesting. Then you can ask, can the company raise its prices without losing customers? Ferrari can essentially double its prices, and customers still want it, because they are the top 1%, top 0.01% in terms of wealth in the world. That doesn't matter. Even in a recession, it doesn't matter. Are you talking about BMW? Also a strong brand, you might think. Not from a shareholder's perspective. If BMW doubles its prices, people will switch to Audi or Volkswagen. I have a soft spot for BMW, it seems. Here are strong brands, the most valuable brands in the world. Of course, brands can decline. Nokia, for example, was quite a brand as well. But that's not enough. That's just one factor. And there also needs to be a good product. Only some companies can rely solely on a brand. In the tech world, that's too difficult. But if you look at the top 25 most valuable brands from, maybe we should address that question later, but it will be all right. These were all consumer companies, the Coca-Colas, the Pepsis of this world. We have, of course, been completely overtaken by tech companies that are so dominant, but also have a strong brand name and rely on that. Well, that's the brand. Then there's the lowest cost price. Well, Basic Fit came up with you, 3 Group, the parent company of Action. Came up. Basic Fit is a bad investment. I'll speak a bit softer, so I won't bring the microphone closer. The lowest cost price. If, as a company, you can offer your service at the cheapest rate, it's actually unbeatable. And there's no one who can purchase fitness equipment as well. As Basic, certified gyms opening 100 or hundreds per year, then you can put pressure on your supplier. You can pass that on to the customer in the form of lower membership prices. Sorry, man. Well, we hope at least that we had the evening. Sometimes it's simply not possible to compete, and that's also the reason for the success of Action. With 2,000, 3,000 stores and building up Europe, then a blocker simply can't keep up with just a few stores, only in the Netherlands. And if you have the lowest cost price as a company, that is enormously attractive. A good example, Netflix. Who can make a series cheaper? Netflix with 300 million subscribers, or a Disney Plus with half. That makes a difference. Twice as much, aside from the difference in subscription prices, but how you can spread the cost of a film over the number of members. In that respect, it's logical that Netflix cannot be overtaken by competitors. Competitors are all unprofitable or barely profitable. And Netflix is extremely profitable because they have the lowest cost prices, thanks to all those economies of scale from having the most subscribers. And that cannot be caught up anymore. Not in terms of content. So Disney Plus has to invest twice as much money, and Netflix invests 20 billion per year. Disney doesn't have 40 billion. There's no one who has that to close the gap. Well, extremely high switching costs. You mentioned Wolters Kluwer. Well, not everyone will know that company. Yes, they make software of all kinds of software for scientific companies. But in principle, if there are entrepreneurs here as well, and if you have an accounting package, people are not going to switch from that. The chance is also quite high in that regard that you are still with the bank where your parents once opened a bank account for you. Switching is sometimes really a pain in the ass, which people do not want. And that can actually yield very attractive returns, because Microsoft is also such an example. Companies are not going to switch from Microsoft Outlook, Microsoft Office, and the like, while there are better, almost free alternatives from Google. This is still the standard in the business world, but it has effectively made Bill Gates the richest man in the world. Network effects. Yes, there is also a reason why Zuckerberg became one of the richest people. We have now mentioned all the people a bit who sat on Trump's lap recently. Network effects. Yes, we are on Facebook or Instagram, WhatsApp, because our friends are on it. And that is so strong. I personally own shares in Booking. Yes. When travelers go to Booking because that is where the most offers are. And as a hotel, you want to be on Booking because that's where the travelers are. So it's a kind of two-sided network effect, which is very powerful and almost impossible to compete against. Now a network can always disappear. Take Hives, for example, before Facebook was here. And when it starts to take off, it goes very fast. So you want to be careful with that. But once it's there, and there are also switching costs, like with Instagram, where everyone by now has set up a very interesting timeline about themselves. You don't just want to leave that. You don't just walk away from it. Well, Apple then. What I sometimes say when I'm standing in front of classes or groups, who has an iPhone? Well, we are very wealthy in the Netherlands, so the majority often has an iPhone. Who will buy, after this device is done, who will buy an iPhone again? Yes, that's almost everyone then. And that's because Apple has such a strong competitive advantage. And that's because Apple has all these 4 competitive advantages, has and possesses them. So a strong brand. If you put your iPhone on the table during a date, the chance of a successful date is much higher. They make most of the devices. They also have only a few variants, including one for you. So a much lower cost price. People are locked in with an iCloud subscription or things like that. And there are network effects. And also exchange all sorts of things between iPhones. And that's the reason that Apple, in the smartphone market, while they only have a 15% market share worldwide, in the Netherlands, we naturally have many more iPhones, but 15% of the units, and yet they capture nearly 100% of the profit in the global smartphone market. The rest of the companies, or with Samsung, are ultimately loss-making. This is really the scale playing there, and that makes Apple a fantastic investment. Many people then naturally want to look for a new Apple because Apple is already a company worth trillions. I don't know if it's always a good idea to go hunting for the next best idea. I think it's usually a bad idea. You can also ride the wave of the best idea for a long time. I mean, 10 years ago, the dominance of the iPhone was already there, quite present. Amazon was also extremely dominant. Facebook was also quite dominant, although they came a bit later. You can sometimes ride the wave of real quality companies for a long time because there's no competition against them. If you want to evaluate your own companies in your portfolio, also test the ones or companies you are interested in, whether it is a strong company, whether it can differentiate itself, then you should actually ask them 3 questions. 1, whether the customer's need for the product is future-proof. Well, continuing to fly, for example, we do that. That need is indeed there. Continuing to bank, we actually want that too, in whatever form. And we also need software to create documents. Well, with ChatGPT, you might wonder if you still need PowerPoint for that matter, because it can just spit them out, a very fast-moving sector. But these fairly meet that first question. But that second question, how likely is it that a product will be copied or disrupted? KLM is continuously copied by various competitors. There are various fintech companies taking business away from ABN AMRO. So that could easily be disrupted in the long term. And this last question, how easily can the company raise prices? ABN AMRO, that's quite funny. They can raise prices quite easily. Banks provide the service for payment services. Every year they increase more than inflation, I believe, and people don't leave. We accept it because of those high switching costs. We don't want to suddenly have to give our new account number to all sorts of parties. We prefer to keep things as they are. Banks know this and always make it more expensive. KLM cannot increase prices at all. Microsoft can really increase prices very easily because customers don't leave, especially not companies. You don't want to experience a new integration with those kinds of things. Okay, if you have a very strong company, then the machine, the car, you still need the driver, a manager who is good at it, because if you put me in Max Verstappen's car, it will be nothing. But if you put Max in a bad car, he will get the best out of it, but he won't become world champion. So those two need to work together, the driver and the car. And yes, actually 3 things on how you can recognize that your company is dealing with good management. Well, one is integrity. Many CEOs did not necessarily become CEOs because they are so honest, but also mainly because they are very good at selling themselves. And that is not always in an honest way. For example, I considered buying shares in Beta Bed, the bed retailer, quite a few years ago. But yes, if you then start doing further research on what the management has said, because you want to investigate it, yes, then you discover that the CEO has blamed the bad weather for poor sales 3 years in a row. That 1 year of bad weather means people don't go to the home furnishing boulevard. That's possible. But 3 years in a row, yes, then something else is going on. Later, it turned out that the German roof was completely rotten and it hadn't been invested in for a very long time. And then you get those kinds of issues. Ownership management itself also holds shares, so it's quite difficult to assess people. But whether they have shares in the company is extremely important. You can find that, for example, in the Netherlands on the AFM website. And if you Google, or I think even if you ask ChatGPT how many shares this CEO has in this company, you'll get quite far. And an even nicer green flag is whether the management has recently bought shares in the company. So putting your own money into your company, yes, that is truly a fantastic signal, because there is only one reason to do that. And that is because the ultimate insider in a company finds that the company is undervalued. Well, with a guru focus, you can find that for American companies and an AFM for a Dutch company. And I think ChatGPT also provides some information about that. The best is always to check the annual report, by the way, because that really contains what is correct. And sometimes news from those kinds of sites where you can find data is not always well understood. If you have those 2 things, management and the moat, strong company, well aligned with good management. I mentioned it earlier, that doesn't necessarily make it a good deal. If you pay too much, and what you want to do in investing, at least that's a kind of value investing. Yes, what type of investor are you? I just want to buy something. I actually want to buy euros and pay 50 cents for them. That makes it a good deal. And that's what this chart is somewhat saying. The stock price, that fluctuating line, goes up and down randomly. Just look up a chart of a company from the past 5 years and you won't see this pattern, but you will see that there is a lot of volatility, a lot of movement, but the underlying values of the company don't change that much. If you look at the company's revenue and profit, they also fluctuate somewhat if the economy is bad, depending, of course, on what kind of company you have, but not as much as a stock price that shows a 50% drop every few years, depending on the type of company. But if you buy when the stock price is well below the intrinsic value, which is actually the real value of the company, then you will make a good deal. Even if the future turns out a bit differently or is somewhat disappointing. If you paid so little for what you get, then you make a good deal. If you buy a Tesla car for $10,000 at this moment, yes, you're simply making a good deal. You can't lose much no matter what Musk does or whatever happens. You're just making a good deal. And conversely, sell when it's above the market value. And why is valuing so important? Here you have the stock price of Coca-Cola, actually, I think since 1985 or so. Really long, 40 years. In the middle, you see here at the top center, you see a total return of 26,000%. So your investment has multiplied by 260. So if you had put 1,000 in there, it would now be 260,000 euros, and 40 years later. A very boring company, extremely predictable. If you look at the year 1998 or so, I don't know if you can see my mouse, but it's not that relevant, but you can see at least from that peak around 1998. If you then fast forward to 2014, you only see that the stock price is equal again. So for about 16 years, the stock price has remained stagnant overall. How can that be? You might think Coca-Cola is a company that has generated so much more revenue and profit every year over the past 40 years. Yes, that's true.
But because the stock price in 1999 and the years before had risen so sharply, much more than the company's fundamentals, you face such a period. And that's why valuation is so important, because there are plenty of companies on the stock markets where the likelihood is high that from now on, the markets have been quite strong for a long time, except for the beginning of this year. The past, or since 2008, it has actually been quite a straight line upwards. There have been declines in between, but markets have risen quite sharply and stocks have become quite highly valued. So I also find the stock market anything but cheap right now. But because of that, you will also see scenarios of many companies that simply show no returns for 10 years, even though revenue and profit are growing. And that's dangerous. You saw it with Microsoft as well. Also from 2000 to 2015, the stock price remained the same. Revenue and profit skyrocketed during all those years. It went quite well. But because you paid too much in 2000, you actually made a very poor return. Paying too much is detrimental. At a certain point, if the stock price stays the same for long enough, just like trying to push a ball underwater and somehow secretly pumping air into it, eventually the pressure becomes so high, the ball becomes so attractive, the valuation so low that it has to rise. And that's exactly what happened after 2015. And the stock has actually increased significantly. In fact, it has remarkably increased sevenfold over 10 years, while it was already a very large company. So yes, this could happen again with quite a few companies. And at the moment, Microsoft is, of course, not as attractively valued as it was in 2015, when there was a price to earnings ratio of 10 times the earnings. Because everyone naturally wants to know how you value a stock. In terms of art, and it's not really science. You want to know what you're paying for what you're getting. Yes, you need a day to fully learn that in this regard. That's why one valuation method is the price to earnings ratio. The most well-known, the simplest, very elegant in its simplicity, but it also has some limitations. You see the formula here. I just mentioned that Microsoft had a valuation of 10 times the earnings in 2015. Suppose the stock price was 20 when you plug it into that formula. Then the earnings per share are €2 per share. Then you get 10 times the earnings. If you then know that the long-term average price to earnings ratio of all companies is 15, Microsoft is at 10, much lower, so you pay less. Then it also depends on what type of company it is. Microsoft didn't have strong management at that time, but it still had a strong competitive advantage. So yes, you could see something like, hey, it has a below average price to earnings ratio and the company is also growing nicely and it has customers who aren't leaving and things like that. Yes, then at some point, a lot of things start to fall into place. And in that way, you could also compare companies to each other using the price to earnings ratio. Hey, the two advertising champions, Meta and Alphabet, one is trading at 20 times earnings, the other at 25 times earnings. Times earnings is even growing faster. You begin to observe those kinds of things in detail when you study such companies. When to sell. Also very good to know because buying is still the easy part. But at some point, your stocks will rise towards that intrinsic value, for example. Yes, it all sounds easy in theory, but when is a good time to sell? Well, can you share a few practical tips that really help? So as a rule, I basically never sell because all my mistakes, I've had Microsoft, I've had Apple. I actually don't dare to mention the other names I've had, which I sold after a 20% or 30% ride. While the simple thing was just to play dead investor and just stay put and ride along. I wanted to look for something better again while I could have just stayed put. It's like you're constantly looking for a new girlfriend. That chasing, it might seem exciting and such, but it doesn't bring happiness. And it's the same in the stock market. You don't need to look for new ideas. If you found something nice, just stay put, play the dead investor, kick that broker off your phone, and just go fishing. At least if that's your hobby, but let the company do the work for you. Don't do the work yourself in that regard. Focus from the start on finding the best, but there can be reasons to sell anyway. Yes, one important reason is a mistake in the analysis. A long time ago, I had shares in Binkbank, which was a broker in the Netherlands. Vispret. Of all Dutch investors were with Binkbank, but they had a high cost structure because at some point the Giro came along and they were much cheaper. I thought, well, nice market share. This can't go wrong. And besides, there are switching costs. People don't switch brokers that easily. Yes, but the investors who trade the most, the day traders, also the group that achieves the worst returns overall, according to scientific research. They went to the Giro. So the most profitable customers for a broker left Binkbank. At a certain point, I realized that. In hindsight, I think, how stupid could you be? But if you've made a mistake in a certain assumption in your analysis, so what you also do is before you buy a stock, you simply write down in a few lines why you're buying it. The best is if you can also explain it to your dog or your partner. And if the reasons why you bought it no longer hold, just sell, even if you're at a loss and that's difficult. But when I see people's portfolios, I actually only see the red numbers staying there for a long time. Just Eat Takeaway is often a large share among Dutch people in the portfolio who bought it at 100 euros. It then went down to 12, such a bleeder. It's so difficult to take that loss. But if you've read Kahneman, yes, psychologically, it's just so difficult. And that's why people bet more in the casino when they're in the red. But when they're in the green, when things are going well, they put some chips in their pocket and play with the winnings. These are irrational things. Ultimately, it's about where your money yields the best. Is that in this stock, which is down 20%? Maybe. The stock is actually worth 40% less. Ultimately, you don't have to earn back your money in the same way in that regard. Some, especially men, just buy more and things like that to make up for it, and that's very dangerous. That's how you can personally go bankrupt. Change in those two that I already mentioned. The mode of management, new CEO. Sometimes a new CEO comes in who wants to implement completely new policies, a whole new strategy. I'm always very wary when someone wants to profile themselves like that. Sometimes there's a competitor that starts to rise and suddenly performs much better. With stock booking, I was a few years ago worried about Airbnb, which was really on the rise and was conquering the market from a different angle. Fortunately, the market has been big enough for both so far. But if Airbnb also starts including hotels, that could be something that threatens or destroys the company. Yes, and then paying too much for what you get. Charlie Munger, Warren Buffett's right-hand man, passed away last year. What people often do is trade a lot, sell stocks for short rides, and in doing so, you actually interrupt the compounding. And compounding, the exponential growth, can be done very easily in companies. Riding along on quality, because every time you sell, you have a problem. Because what are you going to do with that money? That money is then not at work. You'd better just let those companies do the work for you and ride along on such fantastic quality companies like the ones you all mentioned. The problem, of course, is that with every company, there is a risk. Every company you have mentioned here, I haven't included Adobe yet. But there is, of course, an AI risk that the design world no longer needs Adobe or doesn't want to pay for it anymore because other players like JGPT with their new image generator can simply do it much better. Every company has competitors. Every company faces threats, and you just want to be very careful with that. And that's why you don't want to interrupt it. Well, I'm at my time. I would really enjoy answering more questions. Yes, basically until the middle of the night. I think Prince will wrap things up earlier. But if there are questions, I find that really great. And yes, you can also follow me on Instagram or LinkedIn for further things. And then I'll help you. Investing is really fun. And it's more fun when you do it together with everyone. And that's why we're here tonight, of course. Thank you in advance.
Thank you very much, Roland. Are there any questions? You can watch along, Roland, I think in the chat.
Yes. Watch list. Should I handle the questions, or what do you want, Prince?
I think it's convenient if you handle the questions, since I think it's about you. Okay, yes.
Yes, the watch list. I really want to buy shares in the 3 group at Action because I think it's a fantastic concept. Of course, there's a lot of criticism, that it's all a waste of products and such, but the concept and how they do it and how they do small things just a bit differently, which makes them so cheap when you go to Action, but you're surprised at how profitable the company is. They have extremely high profit margins. Yes, and I think they are going to expand throughout Europe because the concept works in all countries. And in that regard, they are now in half of Europe. I think they can go to 10,000 stores, maybe even 3 or 4 times that. And the concept is so simple in that respect. Only the valuation I find a bit steep at the moment. And yes, that's why you build a watch list of great companies, so you can strike when the time is right and those opportunities come for every company.
There's also a bit of a myth surrounding Basic Fit. I call it a bad investment. Can you elaborate on that?
Yes. Well, mainly I look at the stock price since the IPO, and what is it? 2016, 2017, it hasn't really moved. Yes, that is of course concerning. While if you look at it superficially, you might think that Basic Fit and Action are roughly the same. They are both retailers and both can conquer Europe. Only Action doesn't really have a competitor. Of course, all the products from Action can be bought elsewhere, but it is still a certain niche, while Basic Fit has a lot of competition. And yes, setting up an extra gym somewhere, yes, that cannibalizes other gyms. And yes, in that regard, they have grown too quickly. And yes, also a very simple statistic, opening a Basic Fit costs 1.2 million euros, opening an Action costs 400,000 euros. So the entire financial picture and how much profit Basic Fit needs to make compared to how much Action needs to make is already much more difficult. And in that way, that's why I also talked about the revenue model. Look closely at how they earn their money and if there's something underlying there.
Great, thank you. An interesting one you bring up next. What do you think about Nike? Is it a sinking ship? Yes or no?
Yes, Nike has done some really foolish things. If you talk about the management in recent years by essentially telling their big customer, the Foot Locker or similar parties, we don't know, we want to sell directly to consumers. We're going to do less with Foot Locker and pull our products back, leaving room for other brands like On and Aquam, Hoka, and various running shoes, which has caused them to lose a lot of market share. I find it very difficult because Nike is, if you believe in the Lindy effect, if brands have existed for a long time, there's a good chance they will continue to exist for a long time. So with music, with books, that sort of thing, it all applies. And of course, they have been around for 40, 50 years. So I think there's a good chance that they will still exist in 10 years. But they have left the door so open for competitors that it also depends on those competitors whether they can make a comeback. But they do have an advantage because it is still the largest sports brand in the world. And they can offer athletes the most money. So they have certain economies of scale and can reclaim their position. But that also requires flawless execution from the management.
Exciting times for them. Yes, certainly. A question that often comes up is how do you view defense also in Europe and just defensive investments?
Yes, I always had a rule that I don't invest in gambling companies, arms manufacturers, and tobacco companies. Well, that was always a rule, and it used to seem very logical not to invest in defense companies because you just don't do that. But now it has suddenly become very relevant, also in politics. And you could say you should actually invest in defense companies to support Europe in that regard. Yes, I don't do it, and I especially don't do it. Because economically speaking, they are indeed often complex projects. Building a fighter jet, building a certain tank, and the demand is very unpredictable. I mean, look, if we end up in a major war and so on, then it will surely be a good investment. But yeah, how am I supposed to predict if a war is going to happen? Because of that, I feel like I become somewhat dependent on government leaders, whether they will start conflicts to make my investment worthwhile. And I find that too difficult. And I think that you're really just following the hype then, because everyone wants to invest in defense companies. That's a question that comes up a lot. And I think that if many people are asking that question, you should actually look the other way. Especially in that regard, do the opposite. Because the stock prices of a company like Rheinmetall, for example, have, I don't know, increased 5-fold or 10-fold. So a lot is already factored into that price.
Yes, you see that happening very often. That's somewhat related. Do you take into account the increasing anti-Europe and anti-US sentiment, or the shifts in that?
Yes, it's of course very interesting how that will turn out, whether it's mainly bluff poker from America and Trump and his friends. Yes, I don't take it into account much, also with various macro and geopolitical things, because I feel that I can't predict it. And if you can't predict it and have no control over it, why should I do so much with it? Well, I also don't have companies that are very dependent on tariffs and such things. So you don't want too much concentration in your portfolio. If that were the case, I might do more about it. But in general, I let it come to me because I'm staying for the next 10, 20 years, and Trump, whatever happens, will be gone again after 4 years. Well, there are people who doubt that, but yes, then the world probably won't be a very nice place. I think, yes, I always think it will blow over, and the media just pay too much attention to it. We've had financial crises, world wars, world epidemics in the past 100, 200 years, and stocks have risen by 8% per year. Yes, if we have another crisis now and the economy goes bad, yes, it's coming. And yes, I invest for the next 10, 20 years. I'm sure a few more are coming. I can't predict them. I take them. And in the long term, one of those things is, if I ask you, would it be smart to buy stocks in the United Kingdom and England in 1940? Then everyone would think, yes, that's a very, very bad idea if you knew in advance that Hitler was going to invade there. Yet stocks in England were actually quite a good investment during the war years. So even if trouble is coming, it doesn't necessarily mean that the stock prices will perform poorly. I mean, even if you could have predicted the coronavirus, if you had that crystal ball that it's coming, that an epidemic is going to shut down the world, should you be in stocks in 2020? And then you would say, no, but the markets actually rose in 2020. They did dip a bit, but overall they rose, yes. So even if you have an idea about what Trump is going to do or things like that, it still doesn't mean you can predict stock prices with it.
And when you look at your own style, how would you describe your style of investing?
Yes, indeed. Expansion at a reasonable price.
Growth at a reasonable price, explain.
Yes, that's called, if you have to put it in a box, which I don't like, but GARP, growth at a reasonable price. So I don't want those extreme growth companies. You won't see me quickly investing in an NVIDIA, because even though they are so dominant and it's a world that is rapidly changing and has a lot of growth, it can lead to a lot of movement in market shares and competition and things like that. Yes, and I always find that dangerous, because everyone is also looking for the next NVIDIA. Why? And then they start looking at biotechnology companies, speculative arms dealers, blockchain companies, cybersecurity companies. It's so difficult to predict who will be the winner in those kinds of things in 5 or 10 years. I prefer to keep it a bit more balanced, and that's why I want some growth, but at a reasonable level. Because all those others I mentioned earlier are valued so highly, there's already so much expectation built in, that if it doesn't work out, you could be down 80, 90%. Yes, my heart can't handle that.
You already have a case, so let's please leave it at that. Let's answer a question now. Can the webinar be watched again? Yes, we will post it on our site shortly, so it can be watched again. I will come back to that in a moment. I have deliberately stayed away from specific questions about whether you should invest here or there. I think that's not for tonight. Are there any other questions? Well, a question I saw. If you have found companies that meet some criteria except for the valuation, do you then buy a company when the price reaches a certain level or when it actually drops? What is your sweet spot for getting in?
Yes, then it goes on the watch list. You research the company, and only at the end do I look at the valuation. There are often people who start by looking at the price and the chart at the beginning of their research. Actually, you shouldn't look at the price and the chart at all, but rather make a valuation. You need to determine what the share is worth. Then you look at the price and you can see if it's a good deal. Yes, often it happens that sooner or later, such a company becomes attractively valued because there is a temporary problem that can be solved. And those are the best moments. Then people get scared. But if it's a temporary problem, those are the best entry points and the valuation is attractive.
Nice, good. I am going to thank the participants for their participation because I had already said 45 minutes. Well, it has become about 55 minutes max. Thank you very much for participating in this Masterclass. And we sincerely hope beyond that you have learned a lot from it and that these insights that have been shared, I hope they will also help you in your personal and professional development. A special thanks goes to Rowan for his inspiring and motivating speech. I also saw somewhere this has definitely helped. It has given me another step forward, and it has also made us think again. And I must honestly say this leaves us wanting more. We look forward to welcoming you again in the future with something like this, whether it's a masterclass or something else. So keep a close eye on our website and our newsletter for new updates and upcoming activities. And we hope to greet you once more and work together on our shared goals. Here's to a beautiful financial freedom. Once again, Rowan, thank you so much for your inspiring, albeit with a cough, presentation. I hope to speak with you again soon, maybe in this setting or another one. And everyone, thank you. The congratulations or the applause you see in the chat, they are all for you, Rowan. Have a nice evening, everyone. Great to be here. Thank you all. And indeed, have a nice evening, everyone. Thank you. Bye-bye.